What's going on, everyone? So we have a speech that's coming out, or that came out today from the Fed that I'm going to read to you. It's about bringing inflation down. I want to go over this real quick just to give a reminder. So throughout history, there has never ever been something like this happen. Now, this dates back all the way to 2003. As you can see, there's been a lot of reference of 2008 being similar to this current situation. It is in some ways, but in other ways it is completely different. So basically what happened, I mean, you can think what you want, but the evidence is there to support this. Basically in 2019, Fed came in, stepped in as the lender of last resort because the money market funds and interfund lending market was dying. LIBOR to SOFR transition deadline was approaching. Lots of macroeconomic things going on with Fed policy at the time. You had the SLR, supplemental leverage ratio, occur, which basically, if you look back at the stimulus checks that were given in 2020, that's right around the time when the market started to take off, right? Because they leveraged everything and they specifically altered the documentation for what kind of deposits they were going to be accepting to specifically account for savings deposits, which is what a lot of people utilized with their stimulus check because they were at work and there wasn't a lot going on. So anyways, the markets ran all the way through up until about, 2020, into that year, into 2021, early January. It trailed off later that year. The apes were born, all that stuff. And then now we're in 2022, and since the very beginning of this year, we've even trailed off further to the lows that we haven't seen in many of these securities since that time that this all started in 2020. So what is the cause of this? Well, this is engineered inflation. This is the bail-in that's been referred to. You take taxpayer dollars, you put them in the repo market, you finance everything from roads, bridges, student loans, which you then forgive, and other things. Basically everything you could think of. You can go look at the Office of Financial Research holdings of these money market players and see just how much stuff that they're actually holding. But anyways, that is a primary driver of the inflation. It's engineered. They're going to hold it to drive us into recession later next year. Now let's look into the speech real quick. This is by Bernard, and let's see what he has to say about bringing inflation down. This was today. So over the past year, inflation has been very high in the United States and around the world. And then it points to figure 1. Let's look at figure 1. Yes, and again, 2020, stimulus checks hit right around there, a little bit before, about right here actually. And then, market has a hell of a year. Now, high inflation imposes costs on all households, and especially low-income households. The multiple waves of the pandemic, combined with Russia's war against Ukraine, unleashed a series of supply shocks hitting goods, labor, and commodities that, in combination with strong demand, have contributed to ongoing high inflation. With a series of inflationary supply shocks, it is especially important to guard against the risk that households and businesses could start to expect inflation to remain above 2% in the longer run, which would make it much more challenging to bring inflation back down to our target. The Federal Reserve is taking action to keep inflation expectations anchored and bring inflation back to 2% over time. And then they have their super note 1. Let's go ahead and see what that says. 1 says, I am grateful to Kurt Lewis of the Federal Reserve Board for his assistance in preparing this text and to Kenneth Eva for preparing these figures. These views are my own and do not necessarily reflect those of the Federal Reserve Board or the Federal Open Market Committee or the FOMC. Okay, so while last year's rapid pace of economic growth was boosted by accommodative fiscal and monetary policy as well as reopening, demand has moderated this year as those tailwinds have abated. A sizable fiscal drag on output growth alongside a sharp tightening in financial conditions has contributed to a slowing in activity, and in the first half of 2022, real gross domestic product, or GDP, declined outright. Overall, real consumer spending grew at just 1/4 of its 2021 pace, and residential investment, a particularly interest-sensitive sector, declined by 8%. Then we have figure 2. Figure 2 here, and then we have a super note 2 that says, for comparison, growth in the alternative activity measure of real gross domestic income has come in just below potential in the first half of the year. The national income and product accounts contain 2 measures of total economic output, measured through an expenditure approach, reported as much familiar GDP, or an income approach reported as GDI. These two series generally track each other fairly closely, but research indicates that some independent information about the business cycle can be found in each of these series. The gap between the levels of GDP and GDI, known as the statistical discrepancy, was over $750 billion in the second quarter, by far its largest historical size. So let's go back to the text. And then we also had, that was a super note too, okay. Now the concentration of strong consumer spending in supply-constrained sectors has contributed to high inflation. Consumer spending is in the midst of an ongoing but still incomplete rotation back towards pre-pandemic patterns. Real spending on goods has declined modestly in each of the past 2 quarters, while real spending on services has expanded at about half its 2021 growth rate. Even so, the level of goods spending remains 5% above the level implied by its pre-pandemic trend, while services spending remains 4% below its trend. In addition, the fiscal drag and tighter financial conditions, high inflation, particularly in food and gas prices, has restrained consumer spending by reducing real purchasing power. While price increases in food and energy are weighing on discretionary spending by all Americans, they are especially hard on low-income families who spend 3/4 of their income on necessities such as food, gas, and shelter, more than double the 31% for high-income households. Then we have Supernote 3. Since the very elevated prices at the pump in June, the nationwide average of a gallon of regular unleaded gasoline has declined every day throughout July and August, hence the market inverse run, most recently falling below $4 a gallon, according to American Automobile Association. The rise and fall of gasoline prices played a major role in the dynamics of inflation over the summer, contributing 0.4 percentage point to month-over-month personal consumption expenditures, or PCE inflation, the more focal point of inflation right now from the Fed. And that was in June, and subtracting 0.2 percentage point in July. This 0.6 percentage point swing in the contribution of gasoline prices was an important driver of the decline in month-over-month PCE inflation, from 1% in June to negative 0.1% in July. In contrast, food prices pressures continue to worsen, reflecting Russia's continuing war against Ukraine, as well as extreme weather events in the United States, Europe, and China. I'm going to skip over the super notes for now so this doesn't get too long. If you want to read this, I'll link it below. The PCE index for food and beverages has increased each month this year by an average of 1.2%, resulting in an 8.5% cumulative increase in the index year to date through July. For context, the net change in the food and beverages price index over the entire 4-year period before the pandemic was only 0.5%. Now, core inflation, which is inflation excluding volatile food and energy prices, also moderated in July. Core goods PCE inflation decelerated to 0.1% month over month in July after averaging 0.5% in May and June. While the moderation in monthly inflation is welcome, it will be necessary to see several months of low monthly inflation readings to be confident that inflation is moving back down to 2%. How long it takes to move inflation back down to 2% will depend on a combination of continued easing in supply constraints. This is the stuff to pay attention to in the news headlines. Slower demand growth and lower markups against the backdrop of anchored expectations. With regard to supply constraints, a variety of indicators are showing signs of improvement on delivery times and supplies of some goods. In addition, labor force participation showed a welcome increase in the August employment data, particularly in the boost in participation among women in the core working years of 25 to 54 years of age. Even with this improvement, the participation rate is still 1 percentage point below its pre-pandemic level, well in excess of the decline in the participation rate that would have been expected due to the retirements in the absence of the pandemic. Now, reductions in markups could also make an important contribution to reduced pricing pressures. Last year's rapid demand growth in the face of supply constraints led to product shortages in some areas of the economy and high margins for many firms. Although we are hearing some reports of large retailers planning markdowns due to excess inventories, we do not have hard data at an aggregate level suggesting that businesses are reducing margins in response to more price sensitivity among consumers. At an aggregate level in the second quarter, measures of profits in the non-financial sector relative to GDP remained near the post-war peak reached last year. Using the available macroeconomic data, it is challenging to measure directly how much firms mark up their prices relative to their costs. That said, there is evidence at the sectoral level that margins remain high in areas such as motor vehicles and retail. After moving together closely for several years, starting early last year, the new Motor Vehicle Consumer Price Index, which measures the price dealers charge to customers, diverged from the equivalent Producer Price Index, which measures the price dealers paid to manufacturers. Since then, the CPI has increased 3 times faster than the PPI. This divergence between retail and wholesale prices suggests an unusually large retail auto margin. With production now increasing and interest-sensitive demand cooling, there may soon be pressures to reduce vehicle margins and prices in order to move higher volume of cars being produced off of dealer lots. Similarly, overall retail margins, the difference between price retailers charged for a good and the price retailers paid for a good, have risen significantly more than the average hourly wage that retailers pay workers to stock shelves and serve customers over the past year, suggesting that there may also be scope for reductions in retail margins. What did I say? Gas and food is coming down. They're telling you right here. You don't need to watch anyone on YouTube except the guy reading you the document that you wouldn't have read otherwise. That's what's going to happen, because I'm telling you right here. With gross retail margins accounting to about 30% of sales, a reduction in currently elevated margins could make an important contribution to reduce inflation. Well, no shit. Now, labor demand continues to exhibit considerable strength, which is hard to reconcile with more downbeat tone of activity. Exactly. Year to date through August, payroll employment has increased by about 3.5 million jobs, a surprisingly strong increase given the deceleration in spending and declining GDP over the first half of the year. The unemployment rate has fallen on net from 4% in January to 3.7% in August. Possibly the strongest indication that the labor market is tight were the first and second quarter readings of the Employment Cost Index, which point to strong and broad-based growth in total hourly compensation. The 6.3% readings for the ECI in the second quarter was the largest annualized quarterly growth in compensation under this metric since 1982. The most recent readings of average hourly earnings suggested some possible cooling, decelerating from a gain of 0.5% in July to 0.3% in August, although it will be important to see additional data. Holy shit, this is long. Okay, so the deceleration in economic activity thus far this year has coincided with only a slight easing in job openings on net since their peak in March. The current high-level job openings relative to job seekers remains close to the largest in post-war history, consistent with a tight labor market, which is figure 5. Let's look at that. Tight, nice charts. Businesses that experienced unprecedented challenges restoring or expanding their workforces following the pandemic may be more inclined to make greater efforts to retain their employees than they normally would when facing a slowdown in economic activity. This may mean that slowing aggregate demand will lead to a smaller increase in unemployment that we have seen in previous recessions. Oh boy. But it is too early to draw any definitive conclusions, and I'll be monitoring a variety of labor market indicators closely. Let's see what this supernote says. The debate in this area can be seen in 2 recent pieces. See Andrew Figura and Chris Waller. What does the beverage curve tell us about the likelihood of a soft landing? Okay, that might be interesting to read. Okay, so as we follow through on our plan to move monetary policy to an appropriate restrictive stance, the effect of the increased policy rate and pace of balance sheet shrinkage should put downward pressures on aggregate demand, particularly in interest-sensitive sectors like housing. Interest-sensitive. Continued improvements in supply conditions and a further rotation of consumption away from goods and into services should also help by reducing price pressures in goods. With regard to non-housing services, the magnitude of price pressures over the next several quarters will depend on an overall slowing in spending as well as the extent to which labor supply improves in these sectors. Since pivoting last year, our actions and communications have tightened financial conditions significantly and at a much more rapid speed than earlier cycles. So far during 2022, real 2-year yields have risen more than 350 basis points to about 1.2%, and 10-year yields have risen almost 200 basis points and now stand at 0.85% in the range of values for 10-year real yields from 2014 to 2018. The rapid tightening in monetary policy is also reflected in a significant increase in the projected real short rate. The blue chip financial forecast has the expected short rate moving about 0.5% in real terms to a significantly higher level than pre-pandemic with the next 12 months. Within the next 12 months. Let's look at this one. Another badass line chart. This is implied quarter 4 ahead real federal funds rate. And again, they're going to raise it again. Rates are going up, and Rhodes is going to benefit from that. Now, it may take some time for the full effect of these tighter financial conditions to work their way through the economy. The disinflationary process here at home should be reinforced by weaker demand and tightening in many other countries. This is particularly the case as Europe contends with downside risks to actively, This is particularly the case as Europe contends with downside risks to activity and a severe energy shortage caused by Russia's war against Ukraine, and as China maintains its zero COVID approach against a backdrop of weaker consumption. It's because they shut the country down. They're in a COVID loop. Now, at some point in the tightening cycle, the risk will become more two-sided. The rapidity of the tightening cycle and its global nature, as well as the uncertainty around the pace at which the effects of tightening financial conditions are working their way through the aggregate demand, create risk associated with over-tightening. And if history is any guide, it is important to avoid the risk of pulling back too soon following a lengthy sequence of adverse supply shocks to goods, labor, and commodities that, in combination with strong demand, drove inflation to multi-decade highs. To prevent all that, we must maintain a risk management posture to defend the inflation expectations anchor. Got to read this super note. Okay, another reference reading. Where were we? I lost my place. Okay, so we are in this for as long as it takes to get inflation down. Again, the Fed is in as the lender of last resort, and they will not come out of this market until the repo is down or taken care of with their SOFR rates. So far, we have expeditiously raised the policy rate to the peak of the previous cycle, and the policy rate will need to rise further. As of this month, the maximum monthly reduction in the balance sheet will be nearly double the level of the previous cycle. As of September 2022, the monthly caps on the runoff of Treasury securities and mortgage-backed securities are $60 billion and $35 billion per month, as compared with $30 billion and $20 billion, respectively, from 2017 to 2019. Now, let's finish this up real quick. Together, the increase in the policy rate and the reduction in the balance sheet should help bring demand into alignment with supply. Monetary policy will need to be restrictive for some time to provide confidence that inflation is moving down to target. The economic environment is highly uncertain, and the path of policy will be data dependent. Data dependent. They tell you everything you need to know right here. While the precise course of action will depend on the evolution of the outlook, I'm confident we will achieve a return to 2% inflation. Our resolve is firm, our goals are clear, and our tools are up to the task. Now let's look at the charts. 2017, 2019 was the last cycle. Looks like we went up. This is the weekly. 2017 to 2019. 2017 to 2019. Twice as fast. Twice as fast. Have a good night.